one thing that I continue to remind myself is things are never as good as you expect. If you think back to 2021, and are probably never as bad as you expect, which is today. If you look at a public company, it's something like 60-40 debt to equity. If you look at their balance sheet. And if you look at the Bessemer, Cloud 100 index, which is a good representation of the top VC-backed companies, I think it's 98% equity, 2% debt. It's much better to be in a tailwind than to try to be the smartest person picking stocks or picking companies.
Hello everyone and welcome to Fintech Leaders, coming to you from New York City. I'm your host, Miguel Armaza, and I'm a co-founder of Gilgamesh Ventures, a venture capital fund that backs early-stage fintech entrepreneurs in the US, Canada, and Latin America. If you enjoyed this conversation, I invite you to leave a review on Apple Podcasts, Spotify, or wherever you get your shows so more people can learn about fintech leaders. In this episode, I sit down with Billy Libby, CEO and co-founder at Upper90, and Conor Witt, vice president at Upper90. Upper90 is a hybrid fund that invests credit and equity in early-stage businesses. Launched in 2018, Upper90 has over $1.5 billion in assets under management and has backed fintech companies like Octane Lending, Mundi, Thrasio, and many more. In this episode, we discuss combining equity and debt underwriting and how Upper90 has built a team with two different skill sets under the same roof, what they've learned from working with the best credit-driven companies in the market, and what great founders have in common, venturing outside of the US, and why Upper90 sees a ton of opportunity in places like Latin America, how electronic and quantitative trading in Wall Street led Billy to fintech and venture capital, and a lot more. All right. Well, Billy, thanks for opening your doors. We're in the middle of Midtown, Manhattan, right in the headquarters of Upper90. How are you doing today?
Wonderful. Thanks for coming by.
Thanks for welcoming me. So let's do a little bit of quick intros before we start talking about all things fintech, private credit, equity investment, and all that jazz. So Billy, tell us a bit about yourself and your background.
Sure. So I started my career in 2003 in electronic trading. And many people think of that as quantitative trading. And a lot of people ask, how did you go from that world to the tech investing world? And I think the bridge is fintech in a lot of ways, because in electronic trading, you're looking at historical data, you're using that to try to predict future prices of stocks, and then you're using technology to do a lot of little events efficiently. And that's really what fintech does. If it's trying to underwrite an individual borrower or a company and then lending it in an efficient way. So I've always really seen technology helping reduce friction, and I've always wanted in my career to stay closer and closer to technology. And I've always felt it's difficult to take what you learned in the finance world and get credit for it in the tech world. And, you can go and be in the treasury department at Microsoft or a VP of sales at Stripe. And I spent a lot of time thinking about how I can take and get my skill set and apply to the tech world where real change is happening. I met my partner in Upper90, Jason Finger, who started Seamless and Grubhub. And he basically, with me, said the real missing piece is the way startups have been financed is with equity. And sponsor credit, comes in after you raise equity. And in the trading world, you're making the most efficient prices on the public markets. And Jason said founders are giving up way too much of their company because equity is kind of the tool. And as VC and growth equity AUM has gone up tremendously, you've seen direct correlation of founder ownership going down. And so we can figure out how to bring credit into the startup ecosystem earlier, we can help founders on more of their company. We can help founders have a lot more optionality, and they have a lot more ways to exit. And so I think that merging of Jason's world from the tech entrepreneur with mine in the trading world let us think of a different way to bring a product to market, which I think has helped us do something different and has been valuable from founders' perspective.
I've been here at Upper90 for just under 3 years. I help lead sourcing and diligence for new investments and then supporting portfolio companies post-investment. And prior to Upper90, I was at CB Insights and helped lead the Fintech research team there. Prior to that, I was at Citi doing corporate development for the consumer bank and started out doing financial services and Fintech consulting as well.
So there's a lot of things we're going to talk about, but that transition going into VC, at the end of the day, it's a different beast. Did you learn any maybe counterintuitive, any unexpected lessons your first couple of years?
For sure. And we're still learning. And I think it's really important. One of my mentors, a gentleman, Ken Scicciana, who was one of the early partners at TA Associates, said, what do you want to do for the next 10 years? And I think to me, that was being closer to tech and in the startup ecosystem. You see a lot of people that look at it in a much shorter horizon, like a trade. Like SVB had its issue, and then all these hedge funds said, hey, we'll buy SVB deposits over the weekend. Like, that's not a business. Like, that's a trade. And I think what we've learned is we believe the way startups are going to be financed will change. Like, the VC market hasn't really evolved, and it's just gotten bigger. It hasn't changed. And so if you look at a public company, it's something like 60-40 debt to equity. If you look at their balance sheet, and if you look at the Bessemer, Cloud 100 index, which is a good representation of the top VC-backed companies, I think it's 98% equity, 2% debt. So I think the first thing is it's much better to be in a tailwind than to try to be the smartest person picking stocks or picking companies. And everything we do now is captured in data. We see different Instagram ads. We see different Netflix home screens. And our data has led to hyper personalization of our life. And if you look at how companies are financed, it's still the same. And so I just think I've learned that we are in an interesting spot. When we started, equity was very cheap in 2018. So you had to explain to founders why credit wasn't a 4-letter word. And it was very easy to just take equity when there wasn't that much dilution. I think what we found is in this environment, equity is expensive. There's a herd mentality. So a lot of people are on the sidelines, and more founders are thinking about alternative sources of capital. So it's shifted from why credit to why Upper90.
Can I ask you maybe a bit of just to challenge you a little bit? I don't know if it's a tough question or not. So in the VC model, once you make the investment, money's out and it might or might not return. But part of your underwriting is that, a good percentage will go to zero. That's not how credit works, right? And so if you're backing companies with equity and credit, how do you deal with defaults that are inevitable?
So everything is harder now. There's no easy money and everything's more difficult. So when I think about where we come in as Upper90, we're not the first check. When you're doing a seed round like you do in your fund and you do really well, like Nexu, somebody needs to come in and say, there's a great team, there's a great idea, and they need money to execute on phase one. And that, no matter what, is usually an equity bet. Once that happens, the next step often is, I want to then go buy more used cars, or I want to go and do more lending, or I want to do more of what I've done. And then they raise a very big Series A. And that's probably the most dilutive round in the entire financing period. And so what we often do is we are introduced to companies that have some capital intensive need. Could be lending, it could be inventory, it could be equipment, things that have asset value, not venture debt, which is, we believe someone's going to raise more equity in the future. We have to get paid back from the assets we're financing. So we sit down with founders and we'll say, for example, Clutch. Clutch is like the CarMax of Canada, raising a Series A and very good positive unit economics. And they were going to raise a $20 million Series A. we sat down with them and said, what do you need $20 million for? They said, well, $10 million to buy used cars, which we will sell online over the next 30, 60, 90 days, and $10 million for hiring people, building technology, and marketing. The second $10 million is clearly purpose-built for the company and not of value to someone else. The first $10 million, used cars, have clear independent salvage value. So we said, why would you not just raise debt? He's like, well, the investors that we're talking to will only invest if they can put at least $20 million in. And Jason and I are joking. It's like, that's their problem that they raised too much money. That's not your problem. So ultimately, Canaan came into the deal, led the A. We do 90% debt, 10% equity. So we're not leading equity and leading debt. We just want the equity for alignment. And, Dan at Clutch was able to ultimately raise half of the equity, get half of the debt from us, and then has a lot more ownership and just optionality of kind of how he wants to grow.
So there's plenty of debt funds, there's plenty of equity funds, not a lot that sit in the middle where you are. And I guess one of the reasons why that doesn't happen is because it's a different skill set, right? Have you built the team internally to make sure you account for very strong credit underwriting, but also the skills that you need for VC, which we can argue about which ones those are.
For sure. You're always, I think, especially with COVID and people not all being together in the same place, teams and culture. We created a head of people and culture almost 2.5 years ago, because how you kind of scale and build your teams is more challenging now. But to answer your question, I think I kind of break it down in a few ways. Number one, when you find a company before their balance sheet is complicated, often the assets make sense. And somebody's often asks, why would somebody pay you low to mid-teens to finance used cars or generators or a short-term factor, like an Apple receivable, or Mundi, which is, financing products that are exported from Mexico and you have 90-day Walmart payment risk. And the question that we often then go back is, say, what's the cost of equity? A lot more. And it's permanent. And so I just think no one's really asked the question. So the first thing we said is that founders are just not familiar with credit. They're not familiar with tax. They're not familiar with things like depreciation. And the second thing that we learned is a lot of lenders, they make their money just from the lending. So we want to say, number one, do we feel like the assets we're financing provide principal protection, meaning that if the company went bankrupt, our money could be paid back from the assets? Then number two is making sure that we're looking for businesses that are in niche areas, either location or industry, which means that they're able to earn more than what they are paying us in debt. So that's called excess spread. I'm able to charge my clients on an annualized basis 23%, and I can easily service Upper90's 14%. And then the third part is, I just feel like we want to be aligned with the success of our founders. And I think that's a lot of Jason's ethos and just how I've lived my life. And so if they can go and get bank financing, that's an equity positive event. But if you're just a lender and you have warrants, you might be incentivized to lock up that company for as long as possible at a higher rate of capital because you don't have alignment on the equity side. So I think we said very early, we're not going to build the biggest fund in the world. We're going to build a fund big enough. We can do, $10 to $30 million facilities. And we will make part of our returns from the equity. And we're going to put our money where our mouth is. So we actually invest on the balance sheet, not trying to get free warrants. And I think it also changes then, if there's a good thing for the company, you're aligned. And also a lot of what Conor and our team spend time on is how to then add value beyond capital. And so I just think it's a bit of, we want to find companies with good assets and we believe they're creating enterprise value. And I think that's been a big differentiator with companies. And how many credit funds have a tech founder as the co-founder?
I don't know many.
Right? They're all like, I worked at some big fund and now I'm launching my own fund. And founders also don't look for things like they have all these hidden fees and hidden terms. And so I just think you just want to keep it simple, but you only can do that if you have like a different alignment model.
And since we're talking a lot about the value of equity, something that we discussed a little bit offline was how do we evaluate the value of equity, and especially in credit-driven fintechs, which is where you spend all of your day, where I spend a lot of my day. How are you guys thinking about that, especially given where public comps are today?
Yeah, I mean, I think we think about this a lot, and I think like probably for starters, it's okay to be more of a specialty fintech, like balance sheet business, but it's probably just better to accept that or be more explicit about that upfront versus trying to emulate, a high gross margin recurring revenue software business when that's not really what you are. So, I mean, I think there's different ways to think about and ultimately value more of a balance sheet heavy kind of direct lender versus a vertical software business that has, a lending component. And I think that's where we've spent a ton of our time. And we were talking about this before, but, finding businesses that kind of appear to be operating systems for a specific small business industry, often a deskless industry that has, workflow automation, kind of a decomposed ERP as the core product. And, a fintech product is kind of a feature versus the business. Those are the types of businesses that we've been spending a lot of time in categories like trucking and construction and services industries where, the lending is not the only part of the business. It's a way to monetize. It's also a way to accelerate customer acquisition and ultimately kind of deepen that end relationship. So I think it's probably just being more explicitly open up front about like, what do you want to be?
It also sounds like a lot of the industry was mispricing these companies before the market, I guess, woke up. Do you think that's accurate?
I think so. I mean, one thing that I continue to remind myself is things are never as good as you expect. If you think back to 2021, and are probably never as bad as you expect, which is today. So it's somewhere in the middle. And
I'm hearing a bit of Howard Marks there.
Maybe. He has a lot more experience and success. But I just think there's a need for fintech. And a big challenge is you have to acquire customers. And I think that if I look at the companies that have had the most success in the Upper 90 portfolio, companies like Octane Lending, which we were an early partner in, or companies like Mundi, it's either more of a B2B model like Mundi or Octane, but they've also been able to not have to spend all of their margin on acquiring customers. And so a lot of the other companies that are, doing MCA or offering some new credit card, and if you kind of break it down, it's just not differentiated enough. And so the only way they can grow is by loosening their lending standards or spending more on customer acquisition. And I just think you want to try to stay away from those businesses. A lot of our competitors on the credit side, if you look at who's done the credit for them, they like those because there's a lot of capacity. And so I think it's also looking at like the riches are in the niches. And so it's finding these smaller opportunities per se, but you can't build the biggest fund in the world, which we said is okay. And I think you've also said is okay. Yeah, but like a lot of the banks and the shadow banks and the other specialty lenders have been targeting these credit card fintech companies because there's capacity. But it's unclear to me how those create enduring equity value. And now you're seeing this whole system break down because there is no mezz and there's no equity for haircut capital. And it just becomes a really challenging balance sheet problem for these businesses.
Yeah, and you mentioned a little bit specialty lenders, and just thinking of the industry as a whole, some fintech companies might try getting started just with credit and say, I'll add technology later. But then they find themselves with this wheel where credit just produces most of their business. They try to launch software not as great as they would like, so customers keep using the credit, but they can't get out of they themselves being a specialty lender. Do you have any opinions about this type of companies, this part of the market? You know, do you look at these companies?
We try to be disciplined. In an ideal world, we're saying, what are companies that we think have a really interesting asset? And that could be financing YouTube receivables or mobile app receivables. We're, maybe also expanding the definition of what people think of fintech as just lending. I think it's just doing tech-enabled financing. And we're financing right now NVIDIA chips for AI companies where their biggest CapEx expenditure is that. And so I just think there's a lot of ways to finance components of a business where equity would have really been the primary tool. And I think for the first time, a lot of startups, like the cost of building a startup has come down massively, with AWS and the WeWorks and, off like safe notes like Y Combinator. So, however, I've heard for the first time ever, the cost of starting a new business in AI is actually going the other way because of the cloud computing energy and the GPU chips. And so I think there's just like all these new businesses that are going to be created where there's some capital intensity. And Jason Gus at Octane said, look, if you're a capital intensive business or if you have a complicated capital problem, like check with Upper90. And I guess to answer your question more specifically, because it's not a sales pitch for Upper90, it's like, if you're a founder, you want to have different type of investors in your balance sheet. And so if you know that you're going to have a credit need, you probably want to bring in a credit partner earlier because it's going to help build the DNA and the processes and make that a core part of your business. If it's not the risk management and finance and understanding your costs and your COGS and isn't there from the beginning, it's going to be hard to add it later. So it's kind of what you're saying. Like, I think there's a role for equity and debt, and you should think about those being part of the lifeblood of the business earlier. Sometimes businesses raise just credit and they never really have the equity to like build the business, is kind of what you're saying. On the flip side, a lot of people raise equity and then they get credit later. And so it's just the earlier that, and we want to help founders think about this, what is the right balance of equity and debt? And if you know you're going to need both, I think you're going to be much better off bringing those in earlier together versus sequencing them and kind of deprioritizing one versus the other.
Something interesting about your model is that you're working with companies in the US, but also companies internationally. You've mentioned a few. What have been kind of the biggest differences with, or maybe there aren't any, with working with companies in the US versus other parts of the world?
Well, there's a few things. One is you really have to work with local partners because you don't know what you don't know. And there's a lot of ways you can get screwed on the credit side. So we really aim to work with firms like yourselves and others like FJ Labs and other groups that we really feel like have broader domain expertise abroad. That's one. Number two is technology transfers risk in a way I don't think many people think about. So when we first started working with Mundi, and for everybody on the call, Mundi helps Mexican small businesses that are exporting their goods to the United States. You now with technology can track when something leaves a factory in Mexico, when it gets on a truck, when it crosses the border, when it gets on the truck in the US, when it is into the Walmart factory and it's within Walmart's purchase order system. Each node is tracked. On average, Walmart or Target or any large distributor will pay net 60 or net 90 back to the Mexican small business. So if you take a step back and said, how could Upper90 lend money and collect from a Mexican small business and get paid in pesos? In this situation, we're actually taking Walmart payment risk in dollars. And so I think that a lot of it is people confuse everything with venture debt and kind of lending to a business that may or may not exist when actually the collateral has been shifted to a much larger payer. And it just kind of smoothing out this working capital problem. So I think it's kind of understanding what the risk is. In this case, while it's domiciled in LATAM, the risk is in the US. So I think it's kind of understanding the risks. And to do that, we have a team of almost 24 people.
All New York?
We're in New York. I live in Providence. We have a few people in Boston. Jason's in Los Angeles. We have a few people West Coast. And Bill, who are guys who are as our other partners in the DC area. So I think a big part of that is you need to have a lot of firms that like are our size. We have about $1.5 billion across 55 portfolio companies. Some have like 5 people. And so I just think that a lot of firms were built when things were easy, and there wasn't much friction or problems and workouts and refinancing. So now I think to do this well, and to actually add the value to the companies, you need to have enough people, as a credit firm, to ingest 55 loan tapes and give kind of information and insights back to the portfolio company. So I think it's a big part of partnerships, local expertise, but also having and that's kind of my background in quant trading, of having the infrastructure to ingest a loan tape, validate it against covenants, kind of making sure we have as good of an understanding of the credit on a real time or weekly basis as the company.
Do you build a real tech stack inside Upper90?
We have. And, again, from my experience, everyone often asks us, how are you using AI and, all these buzzwords? The people that would be most successful, from my prior life, the Two Sigmas and the Renaissance and the B.E. Shaws and all these firms, they just did a lot of little things very well. It's not rocket science. There's no magical algorithm. There's no magical data set. It's are you capturing data? Are you validating that data's files complete? Are you comparing it against all your covenants? Are you, verifying it against third-party data benchmarks to make sure there's no fraud? How are you invoicing the correct amount? It's just doing a lot of little things well. And in most businesses, it probably is if you look at companies you've invested in that have done well, they've just executed and done a lot of little things well versus some magical piece of the business.
It's step by step, every day.
Correct.
Brick by brick, right?
Yeah, exactly.
Yeah, no doubt about that. I was thinking VC is a very collaborative game. If you look at your prior life, trading, I don't think it's that collaborative. Did you have to unlearn something?
It's a very good question. I think in trading, you come up with, they call it an alpha, kind of an idea, and it's very proprietary, and, non-competes are in years, not months. And yeah, it's very much not zero-sum game, but that proprietary mentality. In the venture world, I agree, there's that collaboration, and almost better to have 3 or 4 groups in a deal than one. I think a lot of our LPs, I believe, run some of the most successful venture firms. And I think I've seen that there's going to be, some different financing mechanisms coming. So I think part of it is that we really built our LP base around founders. And, I probably spent 5 years trying to convince Jason to do this with me. And I think we really wanted to look like our customer. Our customer is the founder, and so I think it's when we think about where we fit, we don't want to be the lead equity. We want to be, just part of the equity. And kind of my pushback is how many VCs do you need in a deal? Get a great lead investor, maybe get another group in, and then us. I sometimes feel like you have 6 VCs, but if you have another problem that comes up, all of those 6 VCs have the same mandate and the same capital. So, why not have 2 or 3 VCs in an Upper90 versus 4 VCs?
Right. And I guess there's also the argument that if you have fewer, they are going to have a bigger stake in your business. And so they're going to be highly incentivized to help you when there's a problem.
That's what I think.
Yeah.
I mean, but I think a lot of this is just helping founders and that, thinking about their balance sheet setup and, how much should they raise versus how much do the investors want them to raise. And often, I look back at Octane, we helped them solve a problem where they had 3 different warehouses, and we gave them a parent loan. So instead of going and getting 3 mezz partners and 3 intercreditor agreements, we were able to solve a problem at the corporate level. And Jason Gus is a, kind of a savant in finance for fintech. But, what he said is that, hey, as I grow, now I have a resid, or I have, my buy box with my bank lenders lets me do power sport financing, but I want to get into RV. A lot of times if you're a company and you want to do something new, even though if it's de-risked, you then have to go and do that with equity. And if you have somebody like us or one of the other credit firms in your balance sheet, it maybe gives you another way to go and experiment without having to use equity, which now is obviously much more tight.
So you keep talking about the founders before we run out of time. So you mentioned that some of the best companies, they've succeeded partially because of their model, partially because they're going with secular trends. They're not going after a shrinking market. But there's also, they're being led by great people, right? So what have you learned about some of the best founders that maybe you've invested in, or maybe that you've just crossed paths with and they might not be part of your portfolio?
Sure. As the market has more volatility, you're always second guessing yourself a little bit. But we've had a lot of success with second and third time founders who no longer care who is the investor. They know what they need and they want to make sure that they have optionality. So we joke like, who's better off or who's smarter? The group that owns 60% of a $100 million exit or 6% of $1 billion exit. And I think if you set up your balance sheet in the beginning, kind of in this mix of equity and debt, now, asset light software businesses, this doesn't make sense. But for a lot of what we're talking about here, fintech and equipment and what's happening, sustainable investing, there's a lot of CapEx, working capital, supply chain finance. So I think there's a lot of founders who, kind of understand that it's like capital has become a commodity. Do people really need that much help? I probably get 50 emails a month of like open job lists, like from hiring. Like we think capital market services are going to be very valuable to founders. Like how do they think about tax and how do they, like all the things we've mentioned. So I think it's founders who have had a couple exits or experiences and are really trying to put together the right capital, not the TechCrunch article kind of focus. That's one. Number two is if we get into an early debate around cost of capital and we get punted to like a VP of finance, it's just like we're arguing about the wrong things. It's like as a founder, you're moving fast and you need to capitalize on your business, right? So it's certainty of capital. We see a lot of people that think they're getting cheap capital. It takes 4 months to get something done with a larger institution and they get retraded and they're in a bind. So speed, then it's flexibility, then cost. And so I think when founders are just thinking about things in that order, because the cost is temporary, it might be like 15 or 16%, but it's for 12 or 18 months. So I think you kind of learn a lot in the beginning and kind of what they're getting fixated on versus kind of what doesn't matter.
So before we go, just thinking about the next couple of years, for both of you, what has you the most excited for Upper90 and I guess for the industry?
Sure. I mean, Conor's really wanted to buy a lot of these Web3 assets at discount.
This is the time.
I'm just kidding. So what I'm excited about is we have seen a lot of new businesses be able to get started online. You can create content now in a really low cost way because of YouTube. You can, be your own boss on TikTok or Instagram. You can start your own store on Amazon. You can, start selling software apps on Atlassian and NetSuite. So what we're excited about is you have a lot of new platforms, Salesforce, that are starting online, where there's a whole ecosystem of small businesses starting. And if you look at what's happened offline, there's been, medical roll-ups in dermatology and RIAs getting rolled up and you name it, restaurants getting rolled up. And so I think that we're still excited about all these new industries online where there's like acquisition financing and roll-ups. And I think we've learned a lot there and think there'll be some interesting opportunities. That's one. I think we've really been excited about some of this like supply chain and trade factors. So there's a lot of onshoring, what's happening in Mexico and, cross-border trade where there's a lot of this, like these working capitals, like in, paid on net terms. So I think like that's something that really excites us. And one other area we've been digging into through our relationships with companies like Crusoe of just in the sustainable investing space, there's, we saw a company that's built the leading electric driverless commercial lawnmower. because there's a shortage of labor, and they're for golf courses and large industrial parks, where now they have a big equipment need for a product, and their biggest issue is getting working capital. And we can help them, like maybe they have a 2-year contract with a big industrial park, and we can help finance some of that revenue forward. So I feel like there's going to be some innovations. Like we've always tried to stay away from things that look and smell like real estate, but people pretend that they're not, and so ghost kitchens, which I'm sure you're familiar with, like we never financed them. One of our LPs said, if you ever were to do something with ghost kitchens, like wait till there's some automation and real change, not just like cutting up a basement and calling it something different. So I think that you're going to start seeing like some of these changes. And I think the AI space we didn't do anything in DeFi or Web3 or anything like that. But AI, it's like, it seems like 20 years ago, you might have had like a data center. Now you have these NVIDIA GPU chips. So it feels like there's going to be some type of new equipment need or CapEx need that comes out of this that Upper90 could help smooth out and finance. And then I was talking to Jason, one of the things that might exist is like, as companies have all these huge preference stacks and structured rounds. I mean, if you're doing a highly structured equity round, it's basically debt, so it's the same thing. You can call it something else. So there might be situations where founders maybe want to buy back their business, where they sold their business and now they want to buy back. So I feel like as an Upper90, it's like helping really think of how to solve some of these challenges for founders where they can be back in charge. So that's like another idea that just comes to mind. I don't know if you have any thoughts, comment.
Yeah, I don't think it's dramatically different from yours. I think it's like the operating system thesis, and it feels like it's widening the field for us of kind of, recurring revenue software businesses solving a problem, where fintech is a way to expand and enhance that, I'd say is one bucket. The second might be like the enabling technologies and fintech products that facilitate that across things like payments, credit, spend management, insurance, and payroll. And I think there's, credit needs associated with each of those. And to Billy's point earlier, I think the kind of tech-enabled software and services roll-ups is something that we've seen a lot of and suspect to continue to see more of. Maybe less of I'm acquiring for the sake of acquiring, but more, I'm a tech-enabled insurance brokerage, and I see an opportunity to buy these mostly, mom and pop businesses that are high margin, but super inefficient and kind of run by people. How do I automate and optimize those and kind of have a 1 + 1 = 3 equation? So debt, of course, it's a pretty, valuable tool to help facilitate that. So yeah, I think those are kind of 3 of the areas and the themes that we're, excited to see more.
The one other thing I just, would speak to a lot of, I'm sure your audience are people like yourself running earlier stage funds and, founders thinking about how to build their business efficiently. And a lot of funds that I've come across, that their model is seed check, get the company going, and then try to get it to Andreessen Horowitz and get a bigger round and a markup. Like no one's getting realized returns on this. It's great for marketing and like unrealized DPI, but how do you go and get returns? And I think if people on this call, like, hey, I want to get this company going, and then I want to think about like phase 2 is maybe bringing some credit in to see if we can do more of it. And once you kind of go down this growth that I'll call path, like it's going to be go big or go home. And I just think, getting a 3x return, someone told me this once, if I played soccer in college at Penn, and if you scored 1 goal a game for the United States or any national team, you would be the greatest player in the history of international soccer. Like everyone's trying to get 10x return. Like if you could get 2x, you're a top decile fund. And so I just think if you rethink about how you achieve that and have more like predictable outcomes and build to profitability faster, it's like this corporate finance renaissance. I just think it's all of us need to think differently about how to finance these businesses where capital markets are going to be shut for a while.
That reminds me, I never bring up Howard Marks, but now this is the second time. One of his memos, it might have been the first one that he ever wrote, talked about exactly that, talked about how they studied the returns of all managers out there, right? And the top performing ones weren't in the top 10% every year. One year, they might have been top 5%. The other year might have been top 15, 1 year maybe top 40%, but they always stayed in the top 50% versus the ones that were chasing to always be 1%, and that led you to some very bad outcomes in some years. So on average, you
when you summarize this, you can say, we are all praising Howard, and he has to talk to Upper 90.
I love the guy. No, amazing. Really, really good stuff.
And congrats on your second fund.
Thank you.
Hope to do more together.
No doubt. Now that we already have a few, so we gotta do more.
Yes.
And I think what's clear from this conversation, AI, no AI, tech, no tech, credit is not going anywhere.
Yes.
So excited to keep following the journey of you guys.
Thank you so much for having us.
Thanks for tuning in, and I hope you enjoyed this great episode with Billy and Conor from Upper 90. If you want more interviews, make sure to subscribe, follow, and leave a review on Apple Podcasts, Spotify, or wherever you get your shows. It helps and means a lot. And if you have any suggestions or thoughts about the show, just drop me a line on Twitter or LinkedIn. Signing off, till next week, I'm your host, Miguel Armaza.